Hello, everyone. Thank you for joining us today and welcome to this presentation of a great way to time and reinvest in your long-term IRA account. Now, today we're going to do something a little different. We're only going to be speaking about investing, a longer-term approach to the market, because our tools can be virtually applied in any market in any time frame. And a lot of people have been looking at the markets as of late and seeing them go pretty much straight up for the last 6 months. And a lot of people have thought that they perhaps missed the boat, or perhaps they even want to reinvest and get back in the market. Now, I'm going to show you some really simple but powerful tools today that you'll be able to apply and be able to do just that. In fact, let me show you how simple it would have been to have caught this last really strong upward move in the markets. As we look at this example here, we see that we had news last week as reported in the LA Times about the economy. In fact, the job report claims that the economy created a robust 235,000 jobs in February. So it states here on March 10th that stocks opened much higher this morning after the Labor Department delivered that upbeat employment report. So that's a great, that's a great way to invest in the market. And this is the way I would say probably 99.9% of people invest, by looking at news and thinking that that's the proper way or time to get in. So as we look at the chart of the Dow, I want to show you actually what happened prior to that. Let's go back to a year earlier. In fact, we'll look back at March in 2016. Now, the market seemed to be going kind of upward but sideways, and someone could have perceived this to actually being rolling over. I'm going to show you two simple techniques today that you could have taken advantage of actually purchasing shares in any particular stock or ETF or fund that you're interested in, either here or even here, prior to the market going up another 3,000 points and well before the actual news came out just last week. Okay, so once again, stay tuned. This promises to be a great presentation today for people that are interested in investing in this market. I'll show you whether it's the right time or whether it's too late, or if you're interested in reinvesting or getting in for the first time. This is a great presentation. Welcome once again. My name is Steven Primo. I'm the president and founder of Specialist Trading. If you're new to my weekly webinars, you'll find out that we are first and foremost an educational company. In fact, that is our only goal, simply to educate you. Even though we provide all of our students and our members with strategies to trade and invest in all markets, Forex, futures, commodities, stocks, and different tools in which to do that, we are more about educating you so that ultimately you can put the power back in your hands and make your own trading decisions. You see, it's my belief through my experience of trading the past 40 years that most traders fail because they're basically giving their power away. In other words, they take all of their decision process from someone or something else, either some convoluted indicator or system or some chat room or some trading guru who's supposed to tell them when to buy, when to sell, what's the perfect market, what's the perfect equity. And this, in my opinion, is a recipe for disaster. What is really needed is to provide all the traders and investors and our students around the world with sound information that has stood the test of time. Now, this is the only way how traders can become consistent, by taking this education and then making your own decisions, not having to rely on an outside source to tell you what to do or how to do it. Okay, I say this because I've been trading for 40 years. I started trading on the floor of the Pacific Stock Exchange. I was on the floor a total of 16 years, and 9 of those years I was a specialist. Now, if you're not familiar with what a specialist was, because there are not a lot of them around that much anymore, only in New York. If you ever look at the old pictures of the people trading, you Google these reports, or these pictures, I should say, of people making all these weird hand signals and paper on the floor, those were specialists. They're the ones that made markets on the stock exchange. So if you wanted to buy or sell a particular equity or issue, you called your broker, and then your broker would contact the floor broker, and he would go up to the trader who specialized in that. So I made markets. I was a specialist for roughly 9 years. I made markets in about 50 stocks. I traded through the crash of 1987 and the bull market that followed. I've been involved in markets in just about any type of environment you can think of, straight up, straight down, sideways, volatile, quiet markets. I've traded just about every system or strategy you can think of in any market. So I know what works in 4 decades of experience, and I know what doesn't work in terms of consistency. So about 8 years ago, I teamed up with Pro Trader Strategies, and we formulated Specialist Trading. where all we do is we educate all of our members in over 110 countries around the world and in virtually every state in the United States, all the things that I have accumulated in my 40 years that have shown signs of consistency and things that I use in my own personal trading. So this is what we do at Specialist Trading. Our only goal is to educate you. And as you'll see today, I'm going to share with you some really great insights and different tools in which you can start using as early as today, if you like, to educate you and put the power back in your hands. So this promises to be a great presentation with a different point of view, more of a investor long-term relationship type of view. But we're going to start in just a few seconds. But before we do, we are required to show you this. So please take a moment to view our disclaimer. I'm going to show you a lot of performance results using these techniques, but please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated in the future. So once again, we're required to show you this prior to all of our presentations. And while you're taking a brief moment to view our disclaimer, I would also like to take this time to invite each and every one of you to follow us on Twitter. That's our handle right there, at SPCLSTTRADG. You may want to copy that down. Every day I post new information, anywhere from strategies that or I should say signals that our strategies have generated in virtually any market, currency pairs, stocks, futures, to little bits of wisdom along the way. So there's lots of great free information, so feel free to follow us on Twitter. Now, as I stated, we are an educational company, so here's what you're going to be learning today, okay? I'm going to share with you what I feel is the proper way to decide the correct time frame, because regardless of what type of trader you are, most traders are trading out of sync with their current time frame or what their persona feels the most comfortable with. So I'm going to share with you how to decide what that correct time frame is and then how to apply correctly with that time frame. Then I'm going to show you how to determine the overall trend. Most traders, think they know the overall trend, but when things change or oftentimes they're trying to, buy at the bottom or sell at the top, and they're out of sync with the overall trend. So I'm going to show you how to do that extremely simple technique. And then lastly, we're going to show how to either time your investments to start investing or to reinvest by trading pullbacks. A lot of traders aren't familiar with what a pullback is. Some of you are. We're going to give you a short refresher course, but then we're going to show you our standard technique for trading for pullbacks. And you're going to see in numerous examples how consistent it is and how simple it can be by just applying these different categories I'm going to be sharing with you. Okay, so let's begin, but just one statement before we do begin. I know a lot of you may have questions as we proceed along, and oftentimes if we stop for every question, the 30-minute to 40-minute presentation will turn into 2 hours. So to keep things running smooth, please hold off on any questions till we get to the very end, probably in about 30 minutes from now. I promise I'll answer each and every one of them, but let's just wait till the very end. The only one I will answer is the most common one, and that is this being recorded? Yes, it is. So if you have to leave early, or if you have technical difficulties, you're not hearing everything properly or seeing everything correctly, contact Pro Trader Strategies. They will send you a link to this recording, okay? So kindly wait till the very end to ask any questions, and let's begin. All right, let's talk about time frames, because I can't tell you, almost on a daily basis, I get people asking me about time frames, and most traders and most investors are out of sync. And let me share with you what you need to do. So if we're determining what the correct time frame is, the first thing we have to do is to determine what type of trader we are. And I would venture to say that the majority of all traders are out of sync with their persona. I can't tell you how many traders contact me and say, okay, Steve, I'd like for you to mentor me, and I want to learn how to day trade. And after we day trade for a while and I teach them what I know, they have tremendous difficulty implementing the rules, and it turns out that it's because they're out of sync with their nature. They really aren't day traders by nature. They're more investors or swing traders. And so they're looking at the wrong time frame. So the first thing you have to do is decide what type of trader you are and be honest. Don't pick something that you think, well, this is the way I'm supposed to trade, so I guess I'm supposed to be this type of trader. Be honest, because if you are an intraday day trader, then the only time frames you should be concerned with are tick charts, minute charts, and hourly bars. That's it. You shouldn't be concerned with looking at daily bars, not at all. You shouldn't even be concerned with looking at anything above that, weekly or monthly, because it's out of your realm. they do nothing to serve to get you in sync with the market. You're looking at the small little waves that hit the shore at the beach. You're not concerned with the large, trendy moves out in the ocean. So don't concern yourself with that. All right. Now, what if you are a swing trader? You have to be honest with yourself. Swing traders are the ones that like to catch those swing moves in the market that may last for weeks, months, but are usually no longer than a few months. Well, swing traders should only be concerned with daily bars and weekly bars. All right, because that's what you're looking for. Swing trades are more like the nice waves you see out 30 to 100 yards out from the beach. And those are what swing traders should only be focused on. You shouldn't be looking at the small little ripples that hit the sand, and you shouldn't be concerned with the large trends out in the middle of the sea. You're only concerned with these waves that are about 100 yards out from the shore. And then lastly, which is what we're going to be talking about today, are investors. Okay, this is going to be our subject of talking today, because this is where most people I've seen are really out of sync with applying the correct time frame. Investors should only be concerned with two time frames at the most, either weekly or monthly bars. And once again, if we use our metaphor for the ocean and the currents and the waves, you're not concerned with the ripples that hit the shore. You're not concerned with the waves out 50 or 100 yards out. You're only concerned with those large major trends out that you can't even see, that are out, miles, hundreds of miles out in the ocean. All right. So there's no reason for an investor to be concerned with what happens on an intraday basis or even a daily basis. I can't tell you how many investors I get that see that the market, such as yesterday when the market was down hundreds of points, say, wow, so what does this mean, Steve, for my long-term portfolio? Should I be exiting? Is this something to be scared about? And I always tell them the same thing. You shouldn't even be concerned with this. This means nothing if you're an investor. The only people that should be concerned with that are swing traders. If you're an intraday trader, well, you're looking at tick charts and minute charts, so it doesn't really matter. So you have to determine the correct time frame, something that fits your persona. Now, today we're only going to be talking about investors and that type of character. And so this is for a longer term approach. Once again, using that metaphor that will help you decide, we are only concerned with those large major swells, those really strong currents, hundreds of miles out in the ocean. Okay? That's the only thing. That's the same thing it is to be an investor. You don't concern yourself with daily activity. And I'm going to show you how simple it is to be in sync with the overall trend if you are an investor. Okay, so you first must decide, and today we're only going to be speaking to those people who have decided that they are investors, or that is a part of their portfolio, and they want to learn how to invest properly. All right, first thing we need to know is to discover what the overall trend is. All right, so many people have an idea of what the overall trend is, and I can almost say that just about the majority of them are incorrect. Everyone's using a different idea of how to find the overall trend is. Let me share with you the simplest and most powerful way that I know of, something that was introduced to me nearly 40 years ago on the floor of the exchange, and that I continue to use on a daily basis in my own personal trading and investing. All right, let's look at our weekly chart of the Dow Jones Industrials. Once again, this was going to last year, starting last March in 2016. All right, someone looking at this would say, well, Steve, we've kind of been inching up here on this weekly chart. I'm an investor, so, I kind of want to know that I'm in sync with the overall trend, but it looks as if we may actually be rolling over. And once again, the guys that I follow, the trading gurus, the investing gurus, they think that the market may be topping out, and this is not a good time to be investing. You have to wait for, to see what's going on with the administration, and there's a lot of stuff about interest rates that may be taking place. And also, we may be tremendously overbought. We've been going up for years now. So this is a good time probably to be on the sidelines and not to think about investing, but to think more about getting out of your long-term positions. All right, does this sound familiar? This is the way most people make their decisions. And did you see how every one of those justifications was based on an outside source? Either what some guru is saying, either what someone is looking at, what's going on in the news, or interest rates, something outside of what's really happening. The only thing you should be concerned with is the chart in front of you. And what is the chart telling you? Well, most of us have never been trained to listen to what the chart is saying. Let me show you how by applying one simple tool, we can know right away what the chart is telling us. All we have to do is apply a 50-period simple moving average. based off of the time frame we're looking at. Okay, so this is looking back at 50 weekly bars and coming up with a simple moving average. We don't need to look at a different time frame. We don't need to take the 50 period of the monthly time frame. It doesn't matter. We just look at the chart we're looking at. And then we ask ourselves, where is price in relation to that 50 period moving average? Now, price is above, okay? Starting in mid to late March and into April of last year, we had consecutive bars closing above the 50 period moving average. So just using this simple tool, which is basically free, anyone can get this on any charting software platform, even online you can get it for free. What is the market telling us? Well, it's telling us on a weekly basis, the Dow Jones Industrial Index is in an overall uptrend. The overall trend is up. So do we want to sell if the overall trend is up? Absolutely not. If the overall trend is up, we are only going to be looking for buy setups. Now, it doesn't mean we're just going to buy at the market. There's no structure there. There's no plan. We're basically just throwing a dart. But we know that we want to be looking for buy setups, okay? And then we all know what happened after that. The market went up 3,000 points. And the market told us well in advance. It told us 6 months to a year in advance it wanted to go higher, well before that news came out. So anyone saying that, oh, it's because of the news the market has been going up, because of jobs, because of employment, it's silly. The market knew it was going up a full year in advance, okay, on a weekly time frame. Now, if we also apply this tool, it can keep us out of trouble as well and tell us when to get out of investments. In this case, it told us, start looking to get in, all right? But we can also look at FOSL, fossil. This is a monthly chart, all right? Now, someone looking at this would say, well, we're okay. We're rallying here. We've had a really nice run up. The stock has really gone up, and we're just coming back. I think it's going to go back up. The chat room or trading room I go to, they really like this stock. They think it's going to go back to 130, 150. And, the earnings are great. And I like the new CEO and the plans he has for the company. And, overall, I'm very bullish about this stock. Right? You see how everything that you decided upon this stock was based off of an outside source, what their opinion was or what they were telling you what to do. Either some institutional source or some trading guru. It wasn't based on what the market was telling us. So let's listen to what the market is telling us by applying the 50 period moving average. Now, coming into this was in 2013 on this monthly chart. Well, yes, we were in an overall uptrend because why? Price was above the 50 period. Now, at this point right here in mid 2014 to late 2014, early 2015, we started to have a little trouble. We were oscillating above and below. Now, the rule of thumb is when using this overall trend technique is you want to see at least a consecutive, 3 consecutive closes either above or below to tell you what the overall trend is. So even though we closed once below here, we quickly bounced back up. But it was at this point that we had 1, 2, 3 consecutive closes below. Okay. So now what is the market telling us? Since we have 3 consecutive closes below, it's telling us the overall trend is down. So you have 2 decisions to make. If you're in this stock, this is a good time to exit because why swim upstream? You're going against the overall trend. There's no reason to hold on to this, okay? Perhaps you bought this stock at, let's say, 20. Well, now it's a good time to take your profits and get out or at least move your stop up to protect yourself if it goes any lower, okay? Don't just hold on to it and hope and pray that we're going to go make new highs and that the new CEO is going to do great things for the company and that the earnings are going to turn out great. I can't tell you the amount of stories where people have bet on that and they've been left with large losses in their long-term accounts. So listen to what the market's telling you that it wants to go lower, so just go with it. Either exit or if you were considering buying this, do not wait on the sidelines until you got 3 consecutive closes above the 50 period moving average. Had you heeded this advice and used this simple tool which doesn't cost anything, it doesn't listen to anyone else, it just listens to the market, well, look how much you would have saved coming into 2017 and in fact into this last month. The stock went roughly from 80 all the way down to 20. And most investors invest this way. They're doing very well, and then when stocks or whatever they're investing in start to go against them, they say, well, it's going to come back, and they hold on and hold on and hold on. And this is what gets them into trouble, and then they usually wind up exiting everything at the worst time possible. All right, so Now I'm going to share with you, now that we know what the overall trend is, and now that we know what time frame we're talking about, if we're going to be investing, how do we actually apply structure to get in? Because all I've shown you right now is the overall trend, and all we've talked about is knowing what side to be on, either to look to go long or at least to stay out of the market. How do we apply structure? Well, we do that with pullbacks. Now, many of you, I'm sure, are very familiar with what a pullback is. But for those of you who aren't familiar with what a pullback is or what it even means, let's just give you a brief refresher course, okay? Now, here's just a standard stick chart, a very generic way of looking at this. But as we see here, this is the way markets usually act. They go up in a type of stair-step fashion, and this is telling us that the overall trend is up. We're in an overall uptrend. And this can work the other way as well. Even if we're going lower, we can see here that when the overall trend is down, we have this kind of a, 2 steps down, 1 step up, 2 steps down approach. Now here's the way, the standard traditional way is to trade pullbacks. A pullback trader likes to wait for an overall trend to be established, either up or down, and then on this sell-off here, that's where price pulls back to some type of mean, reversion to mean, and then according to the parameters of whatever system or strategy you're using, once they are met, that's where you just buy, place an order, place a limit, and with the hopes of the trend resuming. Okay, now it works that way to the upside. It also works that way to the downside. If you're trying to short, which I'm sure as investors we're not trying to, but if you're looking to get out, a lot of times you can get out on this of investment on a pullback to the upside. Parameters are met, and as you can see, the trend goes lower. So this is all well and good because it follows standard traditional way of investing using pullbacks. Here's the only difficulty with that. Because when you're trying to buy based on a pullback, based on whatever the parameters are, you're basically hoping and praying that we stop there. All right, but this is oftentimes what usually happens. You see the parameters happen again, so you think, okay, well, I'll buy some more, I'll reinvest in my long-term portfolio, and this time you get in and it goes even lower. And the same thing can happen if you're going short or if stocks are headed lower. You'll think that, well, the same parameters were met here, so now I'll sell, and then it continues to go higher. And if we look at this generic chart here, this is a perfect example. We see here that we ended the pullback and price went up. We pulled back again and price went up. So now you want to jump in. You say, it's worked before and all the parameters are met, so I'm going to buy right here. And the minute you step in, look what happens. Okay? Does this look familiar to anyone? Now, I know it does to me because when I first started trading pullbacks some 40 years ago, I used the standard traditional way of doing that, and I would basically enter an order to buy and hope and pray that it stopped there, and maybe it would stop for a little bit, but usually I would turn into a long-term investor because things went straight down after that. Okay, so how do we increase our odds for success? Well, instead of blindly placing an order to buy because it worked maybe once and hoping and praying that it's going to work again, we don't want to do that. What we want to do, as you see here, is wait for some type of confirmation that we are headed in our desired direction. And then that is when we step in and buy. And once we see that we've already headed, or we have some type of confirmation that we're heading that way, instead of just hoping and praying that it's going to stop, well, we have the odds in our favor that we will continue. It's the same way to the downside. Rather than hoping and praying that, well, we're going to stop here because the same parameters are met, well, we don't want to do that. What we want to do is wait for confirmation that we're going lower, and then that's when we jump in. And then hopefully the odds are in our favor because we had confirmation from the market. Here's the only difficulty. How do we get confirmation? People always ask me and say, well, okay, Steve, you're right. It's like the analogy you use where you're not going to just jump on a train that comes into the station. You're going to jump onto the train that's headed in your desired direction. Well, it's the same way with confirming that you're going to get into a pullback. You're not going to just jump onto a train and hope it goes where you want to go. It's the same way with stocks. You're not going to just buy a stock and hope it stops there. You're going to wait for it to see that it's going in your desired direction. But even then, how do we feel confident? How do we know when enough confirmation is enough? Well, let me share with you with a tool I was introduced to on the floor that I've been once again using on a daily basis that really confirms this better than anything I know. And this is when we apply the PET-D. If you're not familiar with the PET-D, I've spoken about it so many times before because it's one of our most popular as well as consistent tools we have at Specialist Trading. It's a proprietary color bar algorithm. When I was introduced to it some 4 decades ago on the floor, we had to manually figure out what this formula was on a tick-by-tick basis. But now we don't have to. Now, with the advent of high-speed computers and programmers, what we can do is we turned it into a color bar algorithm. So if you see a series of green bars, it's telling you that the short-term trend is up. All right? If you see a series of red bars, well, it's telling you that the short-term trend is down. So whereas before, when we have the 50-period moving average, that tells us the overall trend. Now with the color bar algorithm, now we know the short-term trend. So everything there is for us on the screen. So here's how we're going to apply it to get that confirmation. In an overall uptrend, you're going to see a small amount of red bars that are going to appear. Now, most people think, well, that's my chance to sell, right? Because it's a red bar. Well, that's only the short-term trend. So the red bar is just simply telling you you're in a pullback within the overall trend. And what you want to do is wait for the next green bar. That's your confirmation that perhaps you want to get in, because it's mainly telling you that the pullback has concluded. So let's look at our example once again in the Dow Jones Industrial Average. Well before that news came out, well before we found out any news about the administration, what was going to be happening with certain things, anything, any other fundamental news, any other economic indicators, okay? We see here that, well, we are kind of going higher to sideways. We have a nice strong move, but once we add our overall trend identifier, well, we see we're above the 50, so we know that the overall trend is up. Now we have to add our structure in the form of the PET-D. Now the majority of the bars are green, but those red bars we see here on this weekly time frame are simply pullbacks. They're nothing to get frightened about until we have 3 consecutive closes below the 50. Now we have the first green bar that followed that red bar, and we have 2 red bars, and then followed by 3 green bars. Then we have another 4 red bars followed by another big green bar. Those were all buy setups. Remember, we're investing. We're not trading here, so we don't have to worry about, well, we have to measure how much we're going to lose and everything. We're holding on for the long term. So we know we're in sync with the overall trend, and we know that the pullback has been confirmed by the first green bars, and that gave us plenty of warning to get long prior to this very strong move that happened. We didn't have to wait for any fundamental news, who's in office, what interest rates are, what the employment numbers are. The market was telling us in advance. And then once we used the PET-D, that was our confirmation in the form of that structure to get back in. Okay? So you see how simple this is. We don't have to make trading complicated. The reason why most traders fail is because they overcomplicate their trading in the form of listening to too many outside sources, putting too many complicated things onto their trading plan, and then not making their own decisions, but relying on these things which have really shown no consistency over the years. So let's show you some more investment examples using the simple pullback techniques, okay? Here's a monthly chart of Apple going all the way back to 2009, okay? As we can see here, looking back in hindsight, yes, we've had a really nice run up in Apple here, all the times it's split and all the big major moves. And someone looking back in hindsight would say, boy, I would have loved to have been able to get back at a really inexpensive price. Well, let me show you how simple it would have been. What's the first thing we do? Obviously, we've been in an overall uptrend, but how did we know we were in an overall uptrend back here when the stock was trading, according to these parameters with the splits and everything, roughly about $20? Well, all we had to do was apply the 50-period moving average. And the entire time, we have been above the 50-period moving average, okay? So we had a number of pullbacks, one here, another one here in 2016. So these were all opportune places to buy before we resumed the upward move. How could we have taken advantage of that? We just apply the PET-D to this monthly chart. And as we see, every time we had red bars above the 50, that was just simply a pullback. And the first green bar would have been your buy setup. You could have purchased Apple back here according to the split and all the, the measured move here, roughly at $20, okay? Now you had another chance in 2013 to purchase it at $70, 3 chances here. You had one chance here to purchase it at $120, and this was at the end of 2015, and this didn't work out too well, but remember, we are investing, so we're just holding. As long as we're above the 50, the overall trend is still up. You're still okay. And then you had one more chance to purchase in July of last year, And look what the stock has done coming into 2017. Okay. So this was all done without looking at earnings, without looking at, economic news. The market tells you everything it wants to do. It's just that we have never been trained to listen to the market. We're always trained to listen to what some guy says on TV, what some indicator says, what some earnings say. Just listen to the market using these simple tools, and you'll be much better off, and you'll be making your own trading decisions. Let's look at a weekly chart of Facebook here, going back to October of 2015. Okay, a couple of years ago, roughly. All right, obviously we've been in an overall uptrend, but how could we have known that well back here? Well, we apply the 50-period moving average. And it's safe to say, well, back here we had consecutive closes above, so we know that we're going higher. So we're not going to sell Facebook, and we're only going to look to get in. Now, where could we have gotten in on pullbacks? Well, right here we have 3 really nice pullbacks, very opportune places to buy at a lower level. How do we do that? We had the PET D, and we can see that when we had a series of red bars, nothing to get worried about. That's just the pullback. That's just the sell-off in an overall uptrend. We're waiting for the first green bar, which we had 3 chances right here. And on the very last chance we had, which was in December of 2017, roughly at 125, and the stock's gone up to 140. So that's 15 points in the first 3 months of the year that you could have made using this simple technique. How about Microsoft? Here's a monthly chart. Once again, we had a really nice run up from 2013 all the way up to 2016. But how could we have taken advantage on this little sell-off? Well, rather than thinking that Microsoft was rolling over, it was above the 50-period, the moving average, the entire time. So there's no reason to think that this was going much lower until we had 3 consecutive closes below. So once we add our PET D, we could have purchased somewhere on these pullbacks right here. How could we have done that? Well, the color bars would have told us to buy on the first green bar after the red series of red bars, here, 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 and here. Okay? So we had 4 chances. The best one was the very first one here at $30 in 2013, just about 4 years ago. Okay? But had you missed that, well, in 2015, a couple of years ago, you had chances to buy it roughly about 45, and look what has happened. The stock's gone up another 20 points since then. Okay? How about Netflix? Oh boy, everyone wished they could have gotten into Netflix, right? Well, looking back here in 2013, we were roughly a $25 stock, all right? Right now it's trading around 150 or so. But how could we have purchased this at roughly about $20, $30? Well, we knew we were in an uptrend because we've been above the 50 the entire time on this monthly time frame. And once we see where the sell-offs were, well, we could have applied our first buy roughly here at 65.70, and our next one's here roughly about par, 90 or par, and the stock has gone up to 145. So even though we couldn't have purchased anything this low, there was chances to get in later on at $60 to $70, okay? About Yahoo, here's a weekly chart. Now Yahoo in 2016 had a nice topping formation and then rolled over. A lot of people thought, boy, this thing is really going to go much lower. There's a lot of bad news. I think I'm going to sell my investment here on a weekly time frame in Yahoo. Well, let's see what the market is telling us rather than some pundits or some institutional investors. The market is telling us it's still okay. We're still okay. We're above the 50-period moving average, so why would you want to sell us, okay? So if the market is telling you that it's still okay to be long or to look how to reinvest, well, then we want to reinvest, obviously, on this sell-off. Don't get frightened of sell-offs. Look for them as buying opportunities as long as you're in sync with the overall trend and as long as the PET D is generating some buy structure for you in the terms of a first green bar here and another one here. So we could have reinvested or started investing in Yahoo roughly around $40, $42, and the stock's gone up to 47 coming into this month. So in the past 3 or 4 months, that's 7, 8 points in our favor. Now, let's look at Google. Now, we realize this is a very expensive stock. We're talking about $800 stock now, but looking back at 2012, we see that this stock was roughly about $300, even though it's still very, very expensive. You could have bought an odd lot, or a lot of investors like to buy these long-term option plays, okay? So how could we have taken advantage of that? Well, first we want to know what the overall trend was. And as early back as 2012, the overall trend was up. So we knew that we would never think to sell or exit our long-term position in Google if we happen to have one. And if we wanted to reinvest, where would we do that? At these points of opportunity right here, on the sell-off in 2012, and then on another one here in 2015. So how did we know when to get into that sell-off? We applied the PET D, the very first green bar here, and the very first green bar here after a red bar, and those were our two places to get in. So we could have entered the first time in 2012 at roughly $320, and if we missed that, we had another chance to get 200 points higher, but that's okay because you could have purchased roughly about 550, and the stock is 300 points higher coming into 2017. Lastly, let's look at Amazon here. Okay, now we're going to go back roughly about 7-8 years back to 2008 when the recession had just started, okay? And when we hadn't even gotten out of it yet, when the markets were really drying up and people were getting out of all their long-term positions. These are buying opportunities if you know when to be in and when to be out. The trouble is most people do the opposite. They buy at the very top, they don't wait for pullbacks, and then they exit, at the very bottom. Let me show you how to take advantage of Amazon and purchase the stock prior to it being even $100 a share. As we see here, we've been slowly heading up coming into 2015, but how could we have taken advantage of buying on these sell-offs here, here, and even here? Well, we apply the 50-period moving average, and even though we had one closing below, we're still above for all intents and purposes. So as early as 2008, coming into 2009, we knew that Amazon should only be looked at as a purchase. We should not be exiting it. So how could we have purchased it? We could have had some really nice opportune pullbacks to get involved in Amazon. Well, here's the first one. We see a series of red bars followed by one green. Here's a couple of red bars followed by the first green. Here's two examples followed by two greens, and here's some more examples. So we had plenty of opportunities to go long. The best would have been back here at the beginning of 2009. I believe this was February, at roughly about $80 or $90. How would you have liked to purchase Amazon at $80 or $90? Okay. And as we can see, the stock is now trading about 10 times that amount. And the entire time, you would still be holding on. Why? Because the overall trend is up, and you even had one more chance to get in right here in 2016. So let's review before we go to question and answers. Here's what you learned today. I told you how to decide on the correct time frame. Now, these methods can be applied to virtually any market, any time frame, but you first have to decide what type of trader you are, because most traders are out of sync with their persona, their personality. If you have very, small amount of risk, you should be, aversion to risk, you should be trading intraday because that's where you have the smallest amount of risk. Now, if you have you're okay with holding positions long, and that's okay, you can hold them all for the long term, well, then you're a more of an investor type of persona. But you have to decide, once you know who you are, do not be concerned with those different time frames. If you're an investor, who cares what happened on a daily basis? That doesn't concern you. You should only be looking at weekly or monthly charts. If the market went down 400 points in one day, it doesn't concern you. You're still okay. Remember, just look to see where you are on a weekly or monthly time frame in regards to the 50-period moving average, because that's how we go to our second category here. How do we determine the overall trend? By using a tool that is virtually accessible to any investor or trader on any charting software platform, and it's free. It's the 50-period moving average. And the way we use it to determine the overall trend is if price is above the 50, well, the overall trend is up, and you should be looking for buy setups. That's it. Or holding on to your position. If price is below, then you should be out of the market entirely, or you should be looking for sell setups, looking ways to go short if you're a trader. Okay, it's that simple. Now, the rule of thumb is 3 consecutive closes, either above or below, to confirm what the overall trend is. And then lastly, we share with you a simple but powerful way to reinvest by trading pullbacks. By investing, most likely you're only going to be purchasing. So what you want to do is see that price is above that 50-period moving average on a weekly or a monthly bar. Wait for a series of red bars to appear. This could be 1, it could be 5 or 10, as long as you're still above the 50. And then the very first green bar is your signal that the pullback has concluded. And that's where you may want to jump in to purchase. It's that simple. We just showed you tons of examples how you could have purchased Amazon at $80, roughly 7-8 years ago. While everyone was selling and thinking that the market was over and we're going into a major crash, you could have been purchasing that, okay? And now, who knows? So many people are saying, well, we're getting towards the end here of this major bull market. Now's the time to be exiting. Well, according to these techniques, no. We're still above the 50-period moving average. And if the bars are green, why fight it? I mean, for all we know, the market could go up thousands of points higher. No one knows. The only way you come up with those type of decisions is when you listen, once again, to outside sources. And it's been my experience in 40 years that outside sources are notoriously inconsistent. They may be right every once in a while, like slot machines, but over time, there really is no consistency in them, just like slot machines. So stick with the one thing that tells you usually what it wants to do in advance, and that's the market you're trading, okay? So as we go forward here, you can see we give a lot of attention to teaching you. That's what we've been trying to do. We gave you different teaching techniques today, and that's our only goal. Not to force feed you signals, not to tell you what the perfect market is or the perfect time frame, not to tell you when to buy or sell, but to teach you these things so that you can ultimately put the power back in your hands by making your own trading decisions. That, in my opinion, is the only way one becomes a successful trader, investor, swing trader. It makes no difference, okay? So as we get ready to close, I'd like to ask you a question before you ask me any. Ask yourself, do you think these edges that I shared with you today, that I taught you, could have helped your investments this past year? Go back and look at your investments. Maybe you got out at the top. Maybe you bought at the top, okay? Could these have helped you in any way? Well, we're going to offer you a great special today. For all the people in attendance today, we have a great discount for you. It's our Pet D, all right? The very tool that we use to determine when the pullback has concluded. We're going to give you a great offer. This is our Primo Early Trend Detector. We call it our roadmap for any market because it can virtually be applied to any market and any time frame and in any direction. In fact, I shared with you what it works with in terms of investors, but let me show you some other markets and other time frames using the same technique. Now, as we see here, here's a chart in crude oil. Using the same technique of buying on the first green bar, you could have done the same thing on daily bars if you're a swing trader in crude oil. If we look at a monthly chart of bonds here, well, the overall trend is up. We have a couple of red bars. Our first green bar, once again, is telling us the pullback has concluded, time to get in, and look what happened. Bonds going up, okay? We don't have to worry about what interest rates are doing or what the reports are. The market is telling us what it wants to do. How about a 5-minute chart of the E-mini, okay? Obviously, the overall trend is up. We're above the 50-period moving average, even though you can't see it here. Here's our first green bar, 8 points in the upward direction right after that happened. This is on a 5-minute time frame. We can go to a 10-minute time frame. We're below the 50-period moving average. We have a pullback to the upside. These are green bars in an overall downtrend. The very first red bar tells us it's time to sell, and 18 points or $900 per contract to the downside in the next couple of hours. How about a 10-minute chart? Here's a 10-minute chart of the E-mini futures once again, and a quick 6 points to the upside using the same technique. If you're a currency pair trader, here's a weekly chart of the Canadian dollar. All right, we have our pullback, the 2 red bars, our first green bar, the same exact structure I talked about today. 1,400 pips or roughly $14,000 in the next 6 months. And you can use this on daily time frame as well. The first sell, first red bar indicates a sell in the dollar yen, a quick 500 pips in the next couple of weeks. So as you can see, whether you're investing, intraday trading, or swing trading, the Pet D can be applied to any market, any time frame. Now this comes included with the add-on, okay? That's the add-on that you can download onto your charting software that will automatically change the bars from green to red. It comes also with 2 continuation trading techniques and 2 pullback trading techniques, as well as a trailing stop technique. So this is in the course for you to learn. Once again, we teach you all that on our video course so that you can learn all these techniques and start applying them by making your own decisions. Lastly, I think the most important thing is it comes with mentoring correspondence. You can contact me via email and get advice and answer any question you have concerning how to apply the Pet D from someone who has been using it on almost a daily basis for the last 4 decades. Okay, I can't think of a better way to learn how to apply this. All right. Now, usually the pet D goes for multiple thousands of dollars. We're discounting the price down to $29.95, and we're also giving you payment plan options. So if you can't come up with that lump sum of $29.95, you can contact Pro Trader Strategies and they'll put together a payment plan. So for a small deposit, small down payment, you can be up and running on a payment plan and start using the Pet D today and start asking me questions on how to apply it for your trading. So here's how to take advantage of this. Once again, my sister site is Pro Trader Strategies. They market and promote all of my courses and techniques. You can email them at trading@protraderstrategies.com. If you'd like to set up a payment plan, which I strongly suggest, that's the best way to get involved and start working with the Pet D, you can call them directly at area code 310-598-6677. Now here's the link at the very bottom here that will take you to that sign up page for the Pet D, but that's not a live link. You would have to copy and paste that. If you go to your chat box on the far right, a live link has been posted there, so you can simply click that on for more information and you can sign up online and be automatically up and running. But I would probably suggest the best thing to do, I'd recommend the best thing to do is to contact Pro Trader Strategies, probably call them. They have numerous trading consultants manning the phones. You can talk to anyone you'd like right now. They will give you more information about the Pet D, go over what type of charting software you have to apply the Pet D to, and they can structure some type of payment plan. So once again, for a small deposit, you can be up and running and be a student of mine ASAP. So I'm going to leave all this information up there. Remember, the chat box on the far right-hand corner will tell you and show you the link for the sign-up page. Let's see. First question, why are you using weekly charts on some stocks and monthly charts on the others? Well, once again, DT, if you were in the presentation at the beginning, we went over the structure of what type of trader you are and what the time frames you should be looking at. And if you were in the presentation, the very first category we talked about was if you decide to become an investor, and that's the type of trader or investor you are, you should only be concerned with weekly and monthly bars. No other. You should not be concerned with daily bars or intraday trading. In fact, I just touched on that just a few minutes ago. So with that being said, I wanted to show you weekly and monthly bars, okay? Because those are the only two charts you should be looking at if you are an investor. If you're an intraday trader, you should never be looking at weekly or monthly bar charts. You should only be looking at tick charts, minute charts, or minute chart, or I would say tick, minute, and maybe some hourly charts. That's about it. Okay, so stick to the time frames which are the most beneficial for the type of trader or investor you are. And since today's topic was only about investing for the long term for your IRA account, then we would only be looking at weekly or monthly. Okay. Stan asks, what about indexes? Should you use monthly or weekly on the S&P? Very good question. Same thing applies. If you're investing, you only look at weekly or monthly. If you're looking at indices, okay, the S&P, the QQQs, the Russell 2000, only look at weekly or monthly to give you an over idea of what the market may be doing. There's no reason to be looking at a daily chart. I can't tell you how many people, such as yesterday, contacted me and said, wow, does this mean we're maybe starting a bear market? That's silly. If you're an investor, there's no reason to be even thinking that. Once again, if you're an investor, you're basically only concerned, if you're looking out the ocean, you're only concerned with the major currents that are maybe 100 miles out in the ocean that you can't even see. All right? You shouldn't be worried about the waves hitting the shore or the ripples coming into the sand. Those are smaller time frames. Brad asks, I understand that the Pet D comes with a fast and a slow version. Which would you use for an investor? Great question. I would say experiment, because there's no right or wrong way. We gave, because we wanted to give the trader and investor both options, we gave them a fast, which is basically the standard, and we gave them a slow. Now, the only difference is that the fast is our standard and is used about 75% of the time. The slow will keep you in investments longer. So this will tell you much better on how long to stay within something, and that is outlined in the course. So once again, there's no right or wrong way. That goes against our philosophy entirely to tell you, no, you must use this one, because that would be similar to us saying you must only trade this way. We want to give you all the different options and variables and then let you decide. So feel free to use them, and then you can come up which one meets your needs and feels the best to you, okay? Let's see, Brad, also, does the amount of data you have on your chart, in other words, year, 2 years, make any difference, or how you apply the 50-period simple moving average? No, as long as you can just get a 50-period simple moving average, that's all you need. You need to go look back 50 bars. So in other words, if you're looking at weekly charts, all you need is to go back at least 50 bars to generate a 50-period moving average. If you're looking at monthly charts, you need to go back, look back 50 bars, and that's it. Well, however amount that comes out to a yearly time frame. The PET-D is such a finely tuned, sensitive tool. It just takes all of its calculations from that bar. So it doesn't need to be looking back more than, I would say, 3 to 10 bars to come up with its calculations. So there's no reason to go back and look 20 years if you don't want to, okay? That's a good question. It's so finely tuned that you'll just need anywhere from, like I said, 3 to 10 bars to come up with a green or a red bar. And here's one more thing I'd like to also mention, because students always ask me this, and prospective students, they say, well, do the bars change colors? Is there a neutral color? And will a bar change from green to red once it's closed? Okay, that's called repainting. And no, the only colors you will see are either green or red. And once a bar closes, whether it's a weekly, a monthly, or a tick bar, it doesn't matter, whatever time frame you're looking at, but once it closes, it stays that color. So you never have to worry the way some other indicators do, some other color bar indicators, where they'll close red and you say, oh, okay, well, that's negative, and then 5 bars later, they change to green, all right? It does not repaint. Once the bar closes, that's it, okay? So it's very, very cut and dry. There's not a lot of room for discretion. And we go over all this in the course and show you, once again, how to use it from someone who's been applying it to their trading for 4 decades now. So I can answer just about any question you have. But remember, we're giving you this and showing you different ways to apply it, and the correct way to apply it, but then letting you run with it. We're not going to tell you this is the only way you can use it. You can only use it this way because this is the right way. There is no wrong or right way. We just try to put the odds in your favor, the things that have shown how the PET-D works the best with. And this, in my opinion, is probably right up there with one of the best ways to apply the PET-D, okay? Using it in this term for a pullback type of trade. So as you've just seen here, trading, in our opinion, is really simple. It's just us who make it more complicated than it has to be. There's no reason you need to go over and look over institutional numbers and look at volume and see the inner workings of the company and see what the earnings are going to be. Trust me, take it from someone who used to make markets in 50 stocks. I did that when I first started trading. I knew the inner workings of all my companies that I traded, and I made markets in IBM at a time. I also made markets in Waste Management, in US Air, Reynolds Metals. I made tons of stocks that I thought, well, I need to know the earnings. I need to know what the makeup is. I need to know who the new CEO is and where the company's ideas are of what direction they want to go. And guess what? There's no way I was consistent using those things. It didn't make me any more money than I thought. So once my mentors told me to stop looking at that stuff, that's where I started using the techniques they share with me, such as the PET-D and the 50-period moving average and a number of other tools. And that's when I started to become consistent. And it gave me enough information and enough confidence to go eventually on my own and to leave the floor after 16 years and to manage money and to trade my own account. So this is what we're all trying to do with you. We're trying to give you the confidence and things that have stood the test of time, where you don't have to rely on what someone says or what some other indicator is saying, and make your own decisions. And that's really what it's about. That's really what it's about in terms of being successful. Keep things simple, and you'll be successful in terms of consistency, okay? All right, as we close here, I just want to really strongly suggest to contact Pro Trader Strategies. They can set up a payment plan with you. So if you can't make that lump sum of $29.95, that's okay. For a small deposit, you can be up and running, and you can be using the PETD as early as today. Okay, we have a great tech support department that can apply it to your charting software. It will be done free of charge, and you can be up and running really soon and have the add-on downloaded onto your charting software. So it's a great, great deal, and you can be contacting me as early as today if you'd like for any questions you may have. In conclusion, I want to thank you so much for attending. I really, really hope you got something out of this. I hope it gave you a different insight in how to invest and how to apply, to your long-term investing portfolio or your IRA, and how to reinvest in the market as well. And I really, really hope that it was able to, give you some more insight into what we do and how we teach at Specialist Trading. And I really look forward to all of you becoming students and members of mine in the PETD course. Okay, thank you so much for attending. I'll see you next time. Bye-bye.